Welcome to TradeTheMBI.com. This is John's Reports for the 5th of February. And, well, you can see this very clearly from when we were talking about, it was last week as we were rising up in here and we were noticing the warning signs of extreme overbought along with our lower shakeout readings with higher highs. And I was warning everybody in our video reports as well as separately in our Skype chat about the reality of increased volatility, as well as we could see in the algos that at least my raw data and that was pointing to the fact that we seemingly were getting less government involvement in the markets, and things were starting to transition, particularly when it came to interest rates, which was represented in treasuries, as well as the rising value of oil, and that those were going to have some negative impacts, at least from the market rise. Now, we had talked about the positive extremes and had talked about very specifically reset points, which were right here, and then subsequently coming into all of these, going all the way back down to, the 27-25 range, going through with all these positive extremes. Now, we've already hit the second positive extreme right here, which is a complete retrace, in my view, of the algos, because I always look to that second one as primary motivation. The original one is usually what gets things moving, and we know that that becomes our retrace value. We could run a Fibonacci on this as well, which, let's go ahead and do that if we just took it from the breakout point and rise it up there. You typically would look for a 50% move, which was going to be right around that 27.74. But if you take it from that second point, it's a little bit more extreme move, and this is where the Fibonacci's become a little less valuable, because normally from a typical standpoint, let's see, we just want to remove this real quick. So while a lot of people try to use the Fibonacci from that standpoint, it's not necessarily effective. When we use our Fib level retrace, which I'll show on my 5K chart, it's a little more dynamic and tends to incorporate itself related to where we see abstract activity, meaning activity that's just been stimulated artificially. So that's generally how it works. But now, this is the Diokon paint. If we get over there, you can see it. It turns red when we get our short signals of, the green midterm buyers below our long-term buyers and a break of our ABM. And I'll show you the other one in a second, where it would normally look for the DOC spread, which is what we call when the cyan moves above red. That's a clear indication that shorts have taken the lead over buyers and are increasing their strength, along with our orange getting into an extreme mode. Now that we've had this reset of short-term buyers, we've had some pretty decent stability. That started to break down once we stayed below the ABM yellow level, and why we were more comfortable talking about being short. And I was telling everyone who was, I'm not going to fight this market. It's like, no, you need to, I was talking about it up here, that you need to be prepared for this eventual turnaround, and why I pointed these very specifically, these points of interest out. Now, NASDAQ, this one shows the buy-sell D. Let's see if I can get it to pop up there. We're going to go right over the actual. Oh my. Pushing too many buttons too fast. All right, here we go. There it is, the buy-sell D test 4, which looks for this situation where you have not just the short indicator of the orange coming above and the green dipping below the red, but also that the shakeout has then moved below this plus 15 level, which indicates that the exuberance has run out, and so that's why it's a little bit later in its shift, but it tends to be more accurate from a actual movement standpoint. And you can see we've a complete reset now of the shakeout indicator here. We've dipped below the red line, so it may persist a little bit longer. If we get an additional move lower of the DOC long-term buyers in red here that will create more. We've had plenty of support from the euro, which has been allowed to free float, which has not made the Europeans very happy. But there's not a whole lot they can do because the Fed letting things go now, and this is definitely a clear change in policy. You can see that don't want to call it the Trump effect, but the fact that they've sort of moved away from controlled environments, and it's something that even Draghi pointed out in his notes. We had talked about this for some while, this artificial inflation of treasuries, that the reality is that rates had to rise and that it was going to get caught up at some point. And it was just a matter of waiting for it. We had our 120 number as the primary, and 113 is an expectation going forward from a broader standpoint. You can see no reset of the steel here, meaning there just aren't that many buyers. You also had the government come out and say that they're looking to borrow nearly $1 trillion as far as issuing new debt. And that's going to put some pressure on rates to rise even further and faster because before you had the Federal Reserve buying up a lot of the debt, which is sort of a circular event. They're pulling back from doing so, and that's going to mean that it's going to drain money from the market. And higher yields mean people will be moving their money out of more risky equity assets, especially after this kind of a run. And that's going to cause increased volatility, which is exactly what we're seeing and what we've been talking about. This added inflationary element was built into the market movement in that it caused prices to elevate for equities just because the market isn't stupid. It knows that there's both a devaluation of the dollar happening along with inflation. So there you have it. And that forces oil to rise because a lot of those that sell oil need to convert into euros for their purchases, which tend to happen in euros, even though they have to trade in dollars. And so some of this is not a supply and demand effect as opposed to a global macroeconomic effect. And to not understand that is why a lot of people miss some of these trades because they just don't see it. And gold, its elevation is not done right now. I mean, you've got now finally the return, but you've had a huge amount of selling recently. And when the market fades in a significant manner, you tend to get that. Now, everyone's all dramatized over, the size of the move, but the reality is percentage-wise really insignificant vis-a-vis. But when you're at 2,700 on the, or 2,800 is where we were on the S&P futures there. A drop of 30 or 40 points is not like it used to be when we were at 1,500. So while it looks dramatic, it's just not that big a deal in my mind. But you can see again here, gold reset of its shakeout developing right there. We had that DOC spread, so it may see a little more weakness to the ABM green level. And also a good one, we had talked about this grand short for Bitcoin and the futures and the inability for a reset. We finally did end up getting a pretty decent signal right here where the cyan dipped below red, which was the first real significant buy we've seen in a while, and we had the lower highs which were pulling in. So once you're over the 50%, you had a pretty good likelihood that you were going to be moving towards that high level right there. But again, it produced similar short setup right there with the falling shakeout readings there dipping below, and that led to the cascade all the way back down. And so no reset, so I would expect even lower than these values for Bitcoin, and it's become a very effective way to see it. We have to shrink our 5K chart here because we were talking about this short from before, and it was an interesting one because I wanted to point this out because it was a perfect situation where we talk about both the long that took place, and then as we ended up with the lack of reset for the steel, we look for these crosses of the steel below the cyan as an indication that the long is about to fade. The problem is you're not going to fade along on rising shakeout. that would be foolish. So you had to wait until further over where you get the second cross of the steel below cyan, where you finally had the shakeout dip, and that became the grand short here. Now there were several other points where you would end up with short little term buys, but again, once you had those steel dipping below the cyans were your transition points. And so while some of these buys were legitimate from their marker, as soon as they dipped below steel, you ended up with the cascading sell, and you could follow each one of these to where it matches those crossovers after the initial buy, and that steel dips below that you know it's going to end. So likewise situation, you ended up with the buy down over here, and we came across, and then boom, you hit the crossover of the steel there, but again under rising shakeout. It wasn't until we began to fade the shakeout right over here, and not coincidental that we hit the 50%. So we would still expect, given what we're seeing from these readings, that we would continue lower. But it's just worth pointing out that we can actually see the market operating within these short-term buy setups. And certainly you might be tempted to, jump into your short a bit prematurely if you aren't paying attention to the fact that until you don't have that rising shakeout, you're still going to have momentum, and sometimes that momentum can play, and this is where sometimes people will short a little too soon within it. But this has been a clear indication, following this all the way along, to maintain a broader short within what you see as short-term little buys within a grand short, and that's exactly how to read a 5K chart like this. So while some people like to move further out in time, I don't find it necessary when you understand this relationship to the readings. And this is what I've been converting into the programs for the color change so that you'll get it. I was thinking about altering it where we have in these little interim buys a lighter color that will reflect that, it's a small buy within it, and until you get the conversion where you would have the cyan below the red, would it finally convert into a, deeper green, also being above that 50% level as well from a retrace. So this understanding may help when some people see things get into consolidation. Here you have significant moves of oversold as opposed to when we have the green and the red just hanging around the zero line, which means there's no real momentum, or as I like to say, it's a battle between longs and shorts, and they're looking for gaps and weaknesses in between each. And so within a broad short like this, you'll get little cover rallies where the shorts will say, okay, I want to take some of those gains, and then they reshort again, and they do the exact same thing, and you get, and the longs recognize that, they add into it, and that's how something can flip for what was really a significant short to a turnaround bull situation where they've found a gap in where the algos were trading. So I know I'm going long here, but I thought I would share some of those insights so that you really get a clue as to how we could see this developing, and that none of it was a real surprise, and there was no guessing about any of it. It was pretty straightforward. So, as always though, look for me in the Skype chat. I will put up any charts as relevant. Trade well.